If you've been struggling with inconsistent trades, then there's a good chance you're missing a structured approach to analyzing the market. A lot of traders jump between timeframes, chase after price, and enter impulsively without a clear plan, but that ends today. So in this video, I'm gonna walk you through a step-by-step process for analyzing the market, starting from the daily time frame down to the 1-minute chart. And we're doing it using only supply and demand. Plus, we're gonna throw some confluences that gives us more edge to our trades. So it's really important to stick throughout this video. Enough with the talking, so let's go into the chart. So why do we start from the higher time frame? The higher time frame is gonna give you the big picture of what the market is doing, the overall direction of the market. So we able to spot key supplies area where price might reverse, and of course it also help you avoid trading against the main direction, trading against the dominant trend, which is one of the biggest mistakes I see traders make. So this supply area and this demand area will check if the price is trending up or is it trending downwards, or if it bouncing between a range. In this situation we can see we are trending up. How do I know? Because we can see we left this area, we can see a formation of this big accumulation over the last 5 months, and we can see here for months the price rejected this resistance level. We see the price kept going downwards, creating consistently from this area. The price kept moving downwards, creating lower lows over lower lows until we reach this point, and this candle is the point of the region of the change of the character. So the market actually changed the main direction from bearish to bullish. Why the market in this situation changed direction? I don't know. That's the reason why we go back in time, and we can see right here, maybe we go to the weekly time frame, we can see the price actually react from this demand, and we know this is a demand area for the simple reason that we see the price ranging inside this box. If we go on the daily, probably is going to be much clearer. The price range a little bit inside this area, and then it breaks out upward, creating like this in a weekly time frame a very strong breakout that breaks the previous lower high. So this lower high was the dominance, because this is the point of origin that creates all the swing movement, creating like this a lower low, but then it stopped respecting it because it broke the point of origin, changing like this the direction of the market. So when the price breaks out, we can see we create the impulsive movement until this point, because this is the highest level price that the price reached, and from this area we start a retracement until this demand area, and we start the retracement exactly in this point. For what reason? Because we can see next to it we have a consolidation area, and then it strongly breaks it below, making it like this a supply area where the price created a reaction, not once but twice. After the last retest in this supply area, the price pushed really sharply downward, reaching this demand area. So in the moment the price reached this area, we know that the price can actually change direction in any moment. So it could be like this, or it could change direction going lower or even lower. But be careful. Let's remember that this low right here should not be breaking. Otherwise it will be a violation and will mean that the price actually is in a downtrend. So we had to check if the price is trending up or is trending down, and analyzing the market in between the weekly and the daily chart, we could have seen that right here the price reacted to this demand area, we changed direction, and right now after this impulsive move we retraced, we break upward again with a very strong movement, and so we know that the price is trending up, so we're only gonna look for buys. Now let's drop down in the 4-hour time frame. Our demand area dash in the daily should be this one, because this is the new demand area we created in the daily. In the 4-hour, this is kind of far away, and we don't want to wait days or even weeks just for the price to retrace inside this area. So we're going to identify what the 4 hours is doing. If we were around this area, the price could easily retrace inside the demand area we mark up in the daily chart and maybe create a reaction. And I really like to scale down with the time frames, because this gives me the opportunity to refine my entries for more precision. So we can see this is a nice demand area we can use, and this is another demand area. I also like to use this candle pattern because this in the lower time frames, because I can recognize from the 4 hours chart that in the lower time frames this is just an accumulation. Let's go in the 15-minute chart. We can see the price consolidate, and so for me it's a very nice opportunity to use it as a demand because the price create a reaction, so we increase the number of participants and then it creates an explosive upward movement. Well, in this case in the 4 hour we are not here to the demand area, but we are actually far away, so we don't want to wait days or even weeks just for the price retracing here. That's the reason why in these cases we're gonna look for new supply zones and new demand zones, mostly demand, because we've seen on a higher time frame that the price is strongly moving upward. So the goal here in the 4 hour is to find the next potential turning point where price might reverse or continue. So I see that the price here reacts in this demand area. It creates an impulsive movement point of the origin, so it's gonna be our dominance. So this means that this low should not be broken if the price want to maintain a long continuation. We retrace inside the demand area, we create a reaction. This is gonna be our new dominance. Here we create a new demand area, so we're gonna refine it a little bit because this is very big. The price retraced inside the demand area, create a reaction. We can see in the lower time frames we actually change character, so the price is keep trending up. And in this moment I like to use as a confluence the DXY. What is the DXY? So I'm gonna click the plus button and I'm gonna add to the chart the DXY. What is exactly this line right here? It measures the value of the US dollar relative to a basket of 6 major currencies, which is the euro, the yen, the British pound, the Canadian dollar, Swedish krona, and Swiss franc. So it's a way to track the overall strength of the dollar against other currencies. So this is a way to track the overall strength of the dollar against other currencies. So a rising DXY indicates a stronger dollar, while a failing DXY shows a weaker dollar. In fact, we can see that DXY moves exactly opposite to what the euro market does. And here instead, we can see that as the dollar begins to weaken and lose value, the euro regains its strength and continues to push higher, while the dollar it keeps pushing downwards. How we're gonna use the DXY to improve our win rate? We're gonna actually check if we are near a demand zone and the DXY is weakening, there's a higher chance of a bounce, and this is what we see here. The euro was near a demand zone while the dollar kept falling, which increased the likelihood of taking the right trades and reduced the chances of going against the trend. So little recap, we react inside a weekly demand, and we can say that because in the daily chart we can see the price is changing direction and it keeps reacting to demand areas until we broke this important level where it shows a strong resistance. Finding ourselves right now in this position right here where the price push upward very strongly. So we drop to the 4 hour. In the 4 hour we see that the price keeps moving in the same direction, respecting all the demand areas that is being created. The last reaction from the last demand happens right here, changing the direction in the lower time frames, creating higher highs and higher lows. So we perfectly know that the markets move into phases: impulsive phase and retracement phase. If you don't know what I'm talking about, go check the previous video. But if you know what I'm talking about, this is the point of the origin of our swing, and we're trying to reach this weak high. High probability of breaking the high and having an upward continuation. Now that we have some clarity going on, we can scale down to the 1 hour time frame. So as I showed to you in the 4 hours, in the 1 hour we were breaking down all the time because we see from this moment the dominant low being broken from this candle, and in fact the price kept pushing lower and lower until we get in this moment where this was the dominant high, because this is the last side that creates the strong downward swing. And you can see the price retrace, it reacts into the supply area, but it couldn't break this level. In the moment that the price is really struggling to break a previous low or a previous high, this means that the price can actually reverse because the buyers in this area are increasing after mitigating the previous demand zone, causing the price to change direction. In the moment it breaks this high, we are in an uptrend. So from the previous dominant high to the last low, this could be our demand area. We can also tighten this area a bit more to have a more action space. I know this video might be a little bit boring, but I'm putting my best effort to teach you, and most importantly, show you the real face of trading without making up to crazy 1 to 50 risk to reward strategies just to get views and attract easy clients for a course I don't sell. This is the situation where I was this morning, and that's why the top-down analysis is so important, because I was actually looking at this in the 1 minute chart with no context, and It was so fucking scary. But in a moment I start contextualizing from the daily until to the 1 hour 15-minute chart, it gets a lot clearer. There was so much clarity with the right context. And so in this moment, I've seen this accumulation going on, and right here I pull up another chart, the S&P 500. I'm gonna use it because if the S&P 500 is dropping, we might see euro dollar struggle to rise because the dollar is gaining strength. But if S&P 500 is rising, like in this case, we might see euro dollar going up with them. So the euro dollar often rises when the S&P 500 goes up. So a strong S&P 500 means investors are buying stocks, which leads to a weaker dollar. And as a result, the euro dollar rises. And I'm gonna even use treasury yields. So if the treasury yields rise, like in this case, it often signals a stronger economic expectation and might strengthen the US dollar. If treasury yields are falling, it's another signal that the dollar is weakening. So in this case, euro dollar at a demand zone is going to be a strong demand signal. So if we see that the treasury are dropping, it might signal economic weakness or lower inflation expectations, weakening the US dollar and make euro USD rise as dollar loses strength. So in practice, you can combine this. If we see the euro dollar near to a demand area and treasury yields are falling, of course in the long term, it could strengthen the case for a potential euro USD rally. So we have the treasury yields that we use as a confluence, and it's telling us that the USD may rise up. We use the S&P 500 and we can see the price is rising up. So it means we got more investors buying stocks, so it's leading to a weaker US dollar, causing the euro USD to rise, and the DXY going to the opposite direction of the euro dollar. So we have all the confluences on our side, and we go to lower time frame to finally enter a trade. So right now we are in a situation where the chart gives us the ability to enter with better precision, and we can set out tighter stop losses. So this vertical white bar that you see is when the London session starts, which for me that I'm from Italy is 9 a.m. I didn't want to enter around this area because that was kind of confusing, and we were inside this range where we can see the price is bouncing off this demand area and this supply area. That's the reason why being patient is one of the most important things in trading, because in this situation many traders would have been driven by FOMO, leading them to lose consecutive trades. In the worst cases, other traders might have done revenge trading, possibly blowing or even failing their prop account. So in this situation, I wanted to wait that the price could have reached this high and breaks it. Why I do not choose this high right here? For the simple reason that yes, it's a high, but it didn't create from this point of origin a swing that break below these lows. So for me, this is not a strong high, but the dominance is this one because it breaks the low and the price kept falling until this point, and you can see that the price is ranging inside and between this swing that is being created. So even if I waited for the price breaking this high, the price could have easily just break the high and then just go lower, because right now we are sideways. We are ranging between a swing high and a swing low. So guys, always be careful to mark up the right dominant high or low. And then around 11 a.m. it breaks it. So in this moment I was like, okay, this is the point of origin where all this movement being created. In the moment the price start retracing, so right here, because it broke an internal low, I take the Fibonacci and I want the price that is gonna retrace at least in the 50%. And so going down here, I've seen that this demand already been mitigated. You can see the reaction from here and the strong upward push, and we got this demand area that hasn't been mitigated. So now we're gonna replay. This is a trade that I took this morning, and so this morning I was waiting for the price retracing inside this demand area and create a possible reaction, aiming for this weak high. So here is where I'm gonna drop to the 1 minute, and I'm gonna wait for the price tapping inside my demand area. So we keep going forward, so we can see we keep breaking the lows. This high is my dominant, so I don't want to see that high being broken. Now remember, around here, around 130, we're a strong news, multiple news. There we go. And we had a new like a retail sales and New York manufacturing index. So that's why I didn't want to take a trade. I actually prefer to avoid it. So I kept waiting and waiting and waiting. For me, this is not a break of structure, because for a real break, in my case, I want to see the body candle breaking above this level. In that case, it's going to be a real break of structure. But just the wick like this, for me, is not a break of structure. So we wait, we wait, we wait. Okay, we actually reacted reacting, but we didn't touch the demand area, so I'm not gonna do nothing, even because we can see here we had inefficiency, and you can see that the price actually pushed below again to mitigate this area. Now from this moment we reached the demand area. I'm gonna wait for a upward confirmation, so it means I'm gonna wait for a structure shift. Okay, so we can see in the micro structure we changed direction, but I'm not gonna enter the trade right now. I want to see something juicy. I really like this. Why is it? Because I see that we are reacting inside this microstructure demand zone, and the price creates a reaction from it, breaking the highs. I don't usually wait for the change of character, because this is actually our high, and a lot of times the price don't even retrace. It don't give a shit. Usually it's gonna happen that just goes and keep going, and you will never enter the trade again. Never. So that's why I like to analyze the microstructure, taking like this a very nice trade. I enter around here, placing my stop loss below this low, because this is gonna be our dominant low, and my TP placed above the last high, making like this a 3.40 risk reward ratio. My trade here been triggered, and the price kept going. I was kind of scared about this situation right here as a supply area, but you know, in a hard time frame we can see we actually have a strong, really strong upward momentum. So I said, you know what, I'm gonna place my trade, I'm gonna place my TP above these highs, even because up here probably there's so much liquidity going on. So I thought there's more probability that the price is gonna break this high. So the price reaching this area, we can see a little reaction from it. It consolidates a little bit, but we can see we create a consolidation, strong breakout. The price retrace in this area, so this could have been another entry point. And if we want to, if we lose this opportunity, or if we want to add another trade, we could enter right here, because this consolidation creates our demand area. But our movement already started, so we have to be careful around these areas, because in this case the price can retrace to this point to react into this demand area and then keeps going higher. So we could enter around this area, but I strongly recommend to not doing it, but just wait instead. So we're gonna wait a little bit more. We can see a little reaction from the demand area, and okay, we can see that the price actually took the liquidity out, and the price keeps reacting in this demand area. So this is our dominant low, so let's see if he continues to respect it. Okay, so it's maintaining the trend direction, so we could have entered like around here with a pending trade, waiting for this reaction, placing the stop loss below here, and go with the 1 to 2. Okay, our trade being triggered, we keep going, and we've been stopped out, but as you can see we didn't break the low still, so we are in a bullish trend still. We see the price pushing upward very strongly, so I would like to try another entry. So this is another accumulation, and I can use it as a demand area. So around here, a little bit higher than that, I'm gonna enter my trade. I'm gonna place it the TP around here, going with a 1 2 3. Our trade being triggered, and let's see how it goes. Okay, it keep respecting the demand areas, and there we go. We hit TP with 1 to 3.41 risk ratio, and the second trade with a 1 to 3, total making 6.41. But I forgot we lost a trade. So we actually earned 5.41, and if I had let the trade run, it would have gone like this. We could have done much more than that, but obviously I wasn't greedy, and I'm satisfied with what we achieved this morning. So yeah, that's how professional traders analyze and execute trades with precision. There's no guessing, no fancy indicators or fancy analysis, just pure price action and powerful confluences. So drop a little fire emoji in the comments if this method has changed the way you look at the market. Don't forget to hit like, subscribe, hit the notification bell for more trading videos. See you guys in the next time. Bye.